Freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, here with Adam Penn. Hey, Adam, how's it going?
Hey, Dustin, I'm doing great.
Good. Having a good day?
Yeah, beautiful Thursday here in California.
It is a beautiful Thursday. I don't know when this episode will air, but it's Thursday when we're recording it, and it's a gorgeous but cold fall day here in East Tennessee. Almost about to be winter. All right, well, let's dive into the topic for today. Kind of excited about this one. I think this is something you and I definitely talk about a lot amongst ourselves, and we talk about to investors as well, and that's like the whole idea of cash flow versus equity. I don't know. You got any opening thoughts on this?
Yeah, it was actually a conversation that kind of came up the other day, and you wrote a newsletter about it a while ago called, you can't eat equity. And this was a conversation I had with a friend yesterday, in that when I was fired from a tech job years ago, back in 21, I believe. And in that moment, the conversation started because she's like, "Your house is dusty." I'm like, "Yeah, I don't have a house cleaner anymore." And I'd fired my house cleaner after I got let go of the tech job 3 years ago, and I just never rehired one. And I was like, "Yeah, I had to cut some things." And she was like, "Yeah, you lost your job." I was like, "Well, I thought about it." I'm like, "Well, I didn't have to cut like essentials, right? Because I still had cash flow, right? It wasn't like I was burning through savings. I was still getting roughly half of my paycheck at the time just through rent being received every month. So yeah, I had to sell my airplane, but I didn't have to, stop buying food or sell my car or any of those things."
That's a really good story, and I've got kind of I guess a different intro into this. You talked about the article that I wrote about you can't eat equity, and I mean I think that's a big thing, right? Like in investing, that's what everyone tries to go for, right? And the default option, especially if you're coming from stock investing, is like you put it into an S&P fund, or it indexes and that grows, right? There's never any focus on the cash flow that it produces. But in a situation where you've got a job loss or something else, that's not, yeah, you can sell, but then you break the compounding and you've got other issues, right? Like you effectively have to
or you're
sell.
penalized if it's in a 401k.
Exactly. And so, yeah, like most people don't focus on that cash flow portion until they're either forced into a situation where they have to, or something else happens. And like, I think that was one of the things that really, for me, I've told the story several times about, I have a finance degree. It was taught the traditional finance stuff. You invest and you compound and it goes, you save for 40 years and then you eventually sell and live off that. Right. And I followed that dutifully right out of school, had a good job with Deloitte, had a 401k, I was saving. And, after a few years of doing that, it was kind of nice. It was definitely aided by the time that I entered the market and started, we were coming out of the great financial crisis. And so, stocks were on the rise and everything like that. And I was saving and making sure to get the match from the company. And was enjoying watching that balance get bigger and bigger and bigger. But kind of the opposite view of what you experience, like that balance getting larger had absolutely no impact on my life, right? Like I didn't have extra cash to go out and do something fun or take a trip or whatever. It was like, okay, this is like, it's nice watching the number get bigger, but realistically, does this mean anything? Like, is this impacting my life today? And I think that was one of the things that really affected me in just the transition to what I'm doing now, is seeing that and seeing it's like, okay, well, this kind of sucks to sit here and think about saving and doing all this work and all this investing. And yet it's like, okay, I'm supposed to wait until I'm old and past my prime before I can start enjoying some of this.
You're old and past your prime now. Don't worry.
Well, that's a separate topic, but yes, you're very true. But yeah, that was the thing, and that's why that really the article that I wrote on this, and we'll toss a link in the show notes. But just about you can't eat equity, right? Like that balance going up did not put food on the table for me. Cash flow does, And so you start investing in things that produce cash, that are going to put cash in your pocket today. Well, that can actually put food on the table. That can put clothes on your back. That puts a roof over your head.
So I think it's important to define what cash flow and equity are, right? Cash flow is going to be regular income. That's going to be your monthly or quarterly distributions that you're getting. Like I talked about earlier in my story, was just the monthly rent that I was receiving, right? It had nothing to do with the equity in the building. Some of those earlier buildings I still have a few $100,000 of equity in them. But this was cash flow that was actually coming to my bank every day. It was paying the bills. It was paying the mortgage. It was giving me something to live off of. And the equity is great, but even when you get that equity, it's a lot of times it's a paper gain, right? It's at the risk of the market until you do something, either sell whatever investment that is, or in the case of real estate, a lot of times you'll refinance it and pull that cash out. And for me, almost every time I've done a cash out refinance or sold a property for a gain, I've just gone and bought another asset that produces cash flow, right? I don't treat that as like I've doubled my money. I just made, from 100 grand to 200 grand. It's been, okay, I got 200 grand. We'll go buy 2 more 100 grand houses and have double the cash flow. So that's really where I think you want to draw that line and understand what you're doing, right? Understanding what you're investing in, and really that kind of just base understanding and the due diligence that we want to talk about in the show. I think this is kind of the beginning of talking about what is it that you're investing for, right? One of our mentors, Russ Gray, says, it's like when people invest in gold because they think the dollar's failing, and then they go sell the gold as soon as it goes up and they just get more dollars. It's like that wasn't the point of their investment, right? So tying this back to what is your goal of investing in real estate? Is it cash flow? Is it appreciation? If you get appreciation, are you going to buy more real estate, or are you converting that back into dollars? That
if you're like me and you kind of came into the investing world through the standard path and stock investing, you don't really think about this too much, right? There's not, especially early on, there's not this emphasis on cash flow. It's not even talked about in these terms. It's just you invest and the number goes up. And what's being talked about there is it's appreciation. It's only appreciation. Every now and then you'll get folks that'll wade into they'll start to think about cash flow, or they might think, oh, well, I need some high dividend yielding stocks or something like that. And so, there's some out there, there's some REITs that have high dividends, and we can go into the pitfalls there maybe later in this discussion. But that's realistically, like for most people, that's the only exposure to this idea of cash flow that they have. And I see very, very few people and very few investors that I talk to who have come from the stock world really think about it in these terms. And they think about, okay, my objective is not necessarily to see the number continue to go up in my brokerage account or my 401k, but it's to increase the cash that's coming into my pocket today so that I can influence lifestyle, go on trips, buy a bigger house,
buy more investments.
More investments. That's a huge one. Yeah, absolutely. Taking, and that now you're talking about like multiple levels of compounding, right? When the cash flow from your investments you're using to go buy more investments, right? Like that's fantastic.
Which might also be gaining appreciation to them as well.
For sure.
I think something that I'd like to cover quickly is kind of maybe a real life scenario, right? Because everyone wants to know, what's your return, right? They all want to boil it down to a number. And I've had investors before on a call, and they're like, I'm looking at your deal and it shows a 14% IRR, and this one over here I'm looking at says 17. And my response to them was, I can make mine say 17. Look, I changed just one number, and the whole thing, it's 17. I'm like, whoa. And it was this understanding of that just spreadsheet magic is easy to change, right? Me and you spend all day essentially deciding whether, what assumptions are going to be most valid so that we can actually hit those in the real world. And so diving into what some of those numbers would look like maybe in a real life scenario, I'd like to just use, I have a case study I like to talk about of just a house that I bought. It was my first rental property I bought, and it was $350,000 back in 2017, I think. And it needed a little bit of work, but I was able to rent it right out of the gate. So it covered the mortgage. So it was positive cash flow. Over the next year or so, rates had fallen just a little bit. So obviously I was in an easing interest rate environment. So all of this helped me out, and value was going up. Either way, we had 30-year fixed debt, so we could have held it. So in this scenario, we were able to refinance, get some cash out of it because the value had gone up from some of the rehabs we had done. When we refinanced it, we got out like $40,000. So now we had less than what we put into the building in it. I had bought it with a 5% down primary investment loan. And then once we did that, I was able to go buy another rental property, right? I lived in them, fixed them up, and turned them into rentals. And so I was able to go buy another one. So that cash out actually got me back all of my money. So now whatever my cash on cash return was, created this thing that, we refer to as an infinite investment, right? It was, I had no money left in the building and it still spits off cash every month.
Let me, and just to make sure, the phrase "no investor left behind" here, the cash on cash return would just be the straight cash yield, so to speak, right? Which is let's say you put $100 into something and it sent you $10 back each year. That's a 10% cash on cash return. And so once you eventually get all of you no longer have any money left in the deal, then that effect, what you said there, you've hit that infinite return model or the infinite return point, which is what so many people try to get to, where you no longer have any money in the deal and yet you're still getting cash flow from it.
Yeah. So you put $100 in, you get $100 back out through a refinance or appreciation, right? You're able to capture some of that initial equity. That's where the appreciation really comes in. And now you've got an infinite return because you have no money left in the deal.
And that's always a point I love bringing up, again, especially for folks, if you're coming from the stock world, you haven't spent much time in this space, you really can't do that with stocks. It's very, very difficult to get this infinite return because there's very few things where you can.
You don't want a margin loan on it.
Yeah, exactly. That's basically the only way you could achieve something like that. But then you're still subjected to the volatility and a potential cash call. And that's one of the reasons I love real estate.
You don't get cash called on 30-year loans with agency-backed debt, right? The value could get cut in half. Look at 2008. Anyone that was able to hold on could still have that loan, right? They could be 18 years, would it be? 16 years into their 30-year loan and still have that same payment as long as they made it all the way through.
That's exactly right. No, that's one of the things, and that it comes back to cash flow, right? As long as you've got the cash flow to continue being able to make those payments in that situation, you can pull off this strategy, this infinite return, in a way that really you can't in very many other asset classes. Certainly not with stocks. You're never going to do this in your brokerage account. You're never going to be able to have all of your original money back from a stock or from an ETF and have effectively zero basis, and yet it's still going to send you cash every month or every quarter. That's just not a thing.
So do you have any thoughts on when each of these things are useful? I mean, we can talk about it from a real estate perspective, maybe on buying a cash flowing rental versus doing a ground up development. But do you want to kind of talk through the mindset around doing both of those, or when each strategy is helpful and how they pair together?
Yeah, I mean, I think everyone can probably tell from kind of our thoughts and comments on this. We obviously love cash flow, right? And that's the thing that we certainly prioritize in personal investments, but then also the investments that we bring to our passive investors. But that's not to say there's not a place for appreciation, right? Like we love that equity growth. That's another big thing with real estate, is you can kind of have your cake and eat it too. So there's definitely a focus for both, right? And I think the story you led off with, right, to supplement either current income or to kind of, especially to provide this like base level of security. If you know that you've got passive income that's going to pay the bills, going to put a roof over your head, it's going to put gas in the car, food on the table, regardless of what else happens in your life, that's a level of security that's just it's massive.
Especially when that's diversified across multiple different assets, right? I look at just my own portfolio. We have oil and gas income that comes in every month. I have a little bit of 1099 contractor income. I have rental income in multiple different cities, across 3 different cities, right? We've got oil in multiple different states. So if there's a hurricane or something, it doesn't knock out all the production, right? Just that you get a way different amount of, there would have to be a ridiculous amount of turmoil for all of those income streams to die at once. And that was something I said to you a while ago when we were talking about doing too many things. I'm like, all of these businesses to a certain extent float each other, right? This podcast that we're doing right now is floated by one of the other businesses that is producing some form of cash flow.
Yep. Absolutely. And that's the beauty, right? And it's cash flow. It's cash in the pocket, and you can kind of choose what you do with that. If it's just supplementing income for lifestyle purposes, again, if it's that security, it's sort of just the rainy day fund. It provides diversification through, it's again, it's like diversified income streams, and you can, when it's cash, it's cash, right? You can redeploy it. I know some people who will take cash flow from their investments and they use that to, again, we talked about buying other investments, but they'll use it to say, go buy gold, right? And and then that's now a store of wealth. They don't actually need the cash flow that's coming from their investments. But they still want to like capture that wealth in something that's outside of the U.S. financial system or the financial system as a whole. And so they'll go buy gold with it, or maybe they buy Bitcoin, which is doing that. That's been a very good strategy recently. So anyway, the biggest point there being there's a lot you can do with cash flow, but I don't want to overlook appreciation. And again, the balance here is that there is a balance, right? As opposed to traditional stock-based investing, which is almost all appreciation. But appreciation is huge in this world too, right? It's really where the long-term wealth is built. Rarely are you building massive wealth through the cash flow. The cash flow can be strong, but that's usually indicative of a very, very large base of wealth to begin with. And it's the equity growth that really provides the growth in your personal balance sheet, right? So seeing that the assets column, seeing that number continue to get larger, that's going to be from the equity growth. And there's different places where that comes into play. You again, with real estate, it's beautiful because you can get both. You can get cash flow, you can get the appreciation at the same time, especially in commercial real estate. Typically, as cash flow goes up, so is your appreciation because the building's going to be worth more. But also there's appreciation plays, and we both know some folks. Robert Kiyosaki is a great example of this, right? He invests in some risky, high-tech startups. He'll invest in things that have a high likelihood of going to zero, but he does that specifically to have that appreciation hit, right? And see that massive growth on his personal balance sheet.
Yeah, him and Ken McElroy took Gold Mine public, right? Kenny was telling us about that the other day. They got to ring the bell in the New York Stock Exchange, which he was disappointed about. He said it was just a button.
Yeah, you're exactly right. But no, so like there's a place for that. But I think, again, it's a balance. You don't go put your entire portfolio into something that is likely to go to zero or has a high probability. But there's still nothing wrong with investing in things that may not have any cash flow, but are still going to have that large hit of appreciation, because that's how you see very large jumps in wealth.
Let's talk a little bit about how maybe you can pair both of those together. I touched on it briefly by saying, one of my rentals, appreciated and provided cash flow, and real estate's a great part of that. Do you have anything on that you want to touch on?
Yeah, I think we've kind of hit on it, but that's one of the beauties, right? Like, it seems like we've had kind of a crazy few years here where inflation's been somewhat out of control, but on a long time horizon, you typically will see rent growth tends to outpace expense growth. And so even though both tend to go up on a long enough time period, you will tend to see your rents go up more than your expenses. And so
we normally underrate 4% rent growth and about 2.5% expense growth.
Somewhere in there, depending on the market, of course.
About a 1% spread.
Yeah.
On average.
And that's fairly typical. And there's a large historical precedent for that. And the beauty of that, again, especially in commercial real estate. So we're talking about real estate here that's valued based on the cash flow it provides, not like single family residential, which is valued based on comps. But when you're in the commercial space, when you see that net operating income increase, then you're going to see the appreciation increase, and there's different ways you're going to see appreciation. You're going to see the value of the property increase, and there's different ways to realize that. You might sell, you can do a cash out refi. There's different ways. The other beauty of that is that sort of continuing growth, you have this built-in inflation protection, which is another reason why everyone loves rental real estate, and especially in things like apartments where you've typically got the rents are going to reset every 12 months at max. So you can kind of keep up with that, and you can continue to pace as inflation goes up. As we see broad-based rent growth, you can continue to capture that, and so that helps actually provide a inflation-protected cash flow stream, because as rents go up, the cash flow goes up, and now appreciation's going up, everything's going up. It's just great.
Yep. Why don't you talk? I mean, we know a lot of very seasoned investors. I mean, Kenny, Robert, a friend of ours named Wes. I mean, we've just got lots of people that have been doing this for decades, and they never lead with appreciation, right? Every one of them has a story of when they made $5 million because the market went in the right direction or whatever. But normally they're not boasting about their net worth or their appreciation on the last deal. They're saying, oh, I just got $10,000 more a month on this, or this thing here spit off $200,000 of cash flow last year, right? You want to maybe dive a little bit into what we see in the most experienced investors?
Yeah, I mean, I think you may have been the first one to actually make this observation, but it's something that, again, no one overtly. I think the folks that we know, they don't, like you said, they don't lead with the appreciation, but they are also not like pounding the table necessarily on cash flow, or at least to the point where it was something that like really stuck out. But it was this pattern that we started seeing among these very successful people, that was what they prioritized. And when they would talk about what they're looking for in an investment, Kenny, we've talked with him a bunch. Cash flow day one. That's like one of his. That's one of the big things for any project that they're doing some
outside of development.
That doesn't count. But for any of their like value add existing apartment acquisitions, that's basically the key criteria. If it doesn't cash flow on day one, they're not really interested in it. Maybe they might be. Maybe there's ways they can make it cash flow, but that's the big thing. And again, it was just an interesting observation that we kept seeing this among people that don't really have a lot of interaction with each other, that don't talk to each other, that, I mean, are maybe play in the same space, but we sort of saw this converging of this same idea of this focus on cash flow first among some very wealthy people that we know. And we're like, okay, there's obviously something in that, right? And what we see is they know if you focus on the cash flow and the cash flow is there, the appreciation is going to follow, right? We live in an environment where there's built into the system is inflation. And if that's the case, you're always going to have increasing asset prices. As long as the rent, and especially in the commercial space, as long as the rents keep going up and they are designed, like the system is built for that to happen, as long as you buy and hold on and can hold through cycles and don't get wiped out by things like a bad debt choice or something like that, as long as the cash flow is there, the appreciation is going to follow.
What do you think? And this just popped into my head. I have friends that were Wall Street stock traders. I've never heard one of them boast about their dividend yields. They've heard them say that they doubled their portfolio, but what does that spark for you?
Yeah, I mean, I think some of it, again, it's where there's just, first of all, a lack of focus in that space, right? You don't invest in stocks usually for the dividends. I mean, some might, particularly retirees. You'll see portfolios that get more geared towards that. But it's just the yields aren't as high. Right, I think you can get a lot higher yields here in real estate land, which is great.
You don't get paid transaction fees.
You pay the transaction fees if you're paying, maybe a commission to a broker if you have a money guy or whatever. Now you've got additional fees on top of that for their management, which is basically just they're going to put you in the fund that they put everybody else into. And
if the dividend's 5%, you're paying a 2% AUM. You just knocked out a third of your cash flow.
Exactly. And so, I don't like those products for cash flow because of the underlying volatility, right? And there's an argument that if you're never going to sell it, then it's fine, right? You effectively, as long as the dividend, as long as the dividend doesn't go down, you lock in the yield when you buy. So that can be good, but then if you're ever in a position that you have to sell, you can have the liquidity, but you might actually take a fairly sizable loss on that because it's a public instrument, right? It's subject to the whims and the ups and downs of the market. And if you're a person like me, like another reason I love cash flow and I love real estate is because I can't help but look at the number, right? Like I want to log in. I still do. Like the handful of brokerage stuff that I still have, I'm looking at it every single day. even though I don't need to, and that's probably not healthy, but I know that about myself. And so that's one of the beauties of real estate for me, is that I can't do that. Right. And so if the focus is on, okay, what amount of cash flow is this actually going to provide? And I know it's like, I'm not going to be worried about the value, because I can't value it. It's fairly illiquid. I'm in this for the long run. It really then forces me to focus a lot more on the cash flow portion, because I'm not going to be focused on those ups and downs.
So, I mean, really, let's kind of focus on real estate here. There's kind of, or let's just say more the private markets in general. There's a few ways that you can either focus on heavy cash flow or heavy appreciation, right? And that could range from, a private debt fund being essentially all cash flow, right? Because it's just debt. You have a note. You're not getting appreciation. It's a fixed return. And then you've got development on the totally other end of that scale, right? Where development's going to be all appreciation, right? There's no cash flow in the interim. Any development deal that pays out cash flow, all they did was over raise the amount of money they need so they could give you cash in the interim, right? So maybe talk a little bit on both sides of the scale, as well as both sides of that spectrum, and then also maybe what's in the middle there.
Yeah, I mean, I think you highlighted it pretty well, right? Like our credit fund is a good example of something that's like pure cash flow. Maybe there is a little bit of
like, I was thinking of that. There's like a hair of appreciation.
There's a
some
tiny
of the notes
bit
are
of
tied to the sales price and whatnot. So
yeah, but it's that's an investment that's designed for cash flow, and it's fairly high, and it's it's certainly much higher than you're going to see from dividend stocks or things like that. But again, you go on this spectrum of all cash flow to maybe something in the middle, like you were saying, where there's value add apartment deals that we look at and that we bring to investors. Those kind of fit both of that, and that's the beauty of the value add space, right? We want to buy something that can provide current cash flow and is going to provide this cash flow component, but we also have an opportunity to do something to force appreciation, and then we can capture that equity growth via a sale or a refinance at some point in the future. And so those things are kind of the best of both worlds, where you can get a little bit of both, and then the total return is made up of both components, right? What you get from the cash flow versus what comes from the appreciation. And then, like you mentioned, the development, nothing wrong with development. It's not generally my cup of tea, partly because it doesn't provide cash flow, right? It's exactly like you said. I like investments that provide cash flow, and development does not. But it can be very, very lucrative for growing your balance sheet. You can double, triple, quadruple your money pretty quickly in that space. So that and honestly, that's a good point to bring up, right? Like there's the risk, like there's a direct correlation to the risk here too, right? Like as you kind of go further up that spectrum to more appreciation heavy type investments, those are generally higher risk. They're going to have those bigger returns. They're going to have the eye-popping numbers, but you're also taking more risk that could be cut in half or go to zero.
So I was going to say, let's talk about that risk really quick, right? And we brought this up, I think, before on the show, but if you have $1 million and you invest $100,000 into a development deal and it goes to zero, I mean, it's not that risky, right? We're talking about it like it's a crazy risky thing. It's just riskier than buying a cash flowing building. But if you put it into some private equity, venture capital thing and it goes to zero, you only need to make like a 12% return. I should look at the spreadsheet and figure out that number. It's like 13.1% on the $900,000 remaining to get back to $1 million. That's doable, right? I mean, there's years that you could do that in the stock market easily, right? Even some dividends in the stock market, you could do that in 2 years. But if you put $500,000 of that $1 million into that venture cap deal, and you lost all of it, now you need 100% return on the remaining 500 to get back to where you were. So I think a lot of that is portfolio risk mitigation. Do you want to talk a little bit about, maybe evaluating personal finances and just kind of about the strategy that we've just talked about and kind of the due diligence on both types?
Yeah, for sure. I mean, I think this is something that for me personally, it took some, like I didn't know right out the gate that like I was a cash flow focused investor, that's the thing that meant to me, to go back to the story about me being out of school and seeing that 401k balance grow. Like, it took me seeing that and coming to the realization of, okay, my life looks absolutely no different, for me to realize, like, okay, I don't really like this. So I think, no one had ever really shown me another path, so I didn't have anything to compare it to. But if I could go back and like give advice to myself, it would be, okay, well, think about what matters. Like, do you want more cash in your pocket now? Some people don't, and that's totally fine. But you need to make sure that whatever you're investing in aligns with kind of what matters to you and your own personal objectives. If you don't, what's the saying? If you don't have a goal, you'll hit it every time, or you'll miss it every time, or something like that. Like, if so many people go out with their financial goals, or they just start investing without a true endpoint in mind, or actually understanding what's important to them. And so, like, establishing that first and kind of figuring out, okay, do I want that cash flow in my pocket, or am I more of a, no, it's fine, like, we'll see the big returns later. Because if you are that type of person who really doesn't care about cash flow, and you invest in a debt fund, you're probably going to be unhappy with that, right? You're going to be like, well, this is boring. So you've got to make sure that what you invest in is aligned with your goals, and that takes a lot of introspection. So it'd certainly start with that, right? You have to kind of figure that out. Figure out your own personal financial situation and what matters. Do you need the additional cash flow? Is that something where you're like, I've got these trips I want to go on. Some development deal that's going to pay off in 5 years is not going to allow me to go on a trip next year, right? Whereas something that's spitting off 12% cash on cash every year might. So you got to kind of like make sure that there's not this misalignment. And keep in mind too that changes over time, right? It changes as you go through stages in life. Usually people tend to get more cash flow focused as they get older. That's not necessarily the case, but you have to kind of go through this on a recurring basis. And then really you asked about due diligence. I mean, it's different for each different type of investment, right? If it's a syndication, you always want to be looking at the sponsor, knowing them, knowing the operator, asking for track record, things like that. If it's more of a cash flow based fund, you're depending on the instrument that is being invested in, right? If it's mortgage notes in a debt fund, you'll ask different questions than an operator that's been doing development for 20 years, right? So you have to kind of understand a little bit about what it is that you're actually investing in, and then tailor some questions to that. One of the things I love nowadays, honestly, you can just, if you were new to this, didn't know where to start, go to ChatGPT, be like, hey, I'm looking at investing in XYZ type fund. What are some questions? What are some due diligence questions I should ask? And you'll get some very excellent responses. So there's always, again, if there can be an education curve in this space, and I think that thanks to AI and some other tools and the information that's out there, hopefully this podcast is one of them, right? We're trying to shorten that and flatten out that curve a little bit more. But yeah, you definitely want to be doing a lot of due diligence on these things, and especially if you're going to be more in the more speculative the investment, you typically want to be doing more due diligence.
Well, what I know on our next episode we're planning to talk about goal setting, so that kind of segues pretty good into that. What do you want to leave listeners with this time?
No, I just I think the biggest things would again, if you've never been exposed to this world, understand that there is this cash flow component, right? This was me. I go through the traditional finance education and not really exposed to cash flow too much. And so I didn't know that this was a way that you could really gear an investing strategy for someone that's not like 65 or 70 years old, right? So understand the space, and then figure out, like, do that goals analysis. Figure out what matters to you. If cash flow doesn't matter, then that's totally fine. I think for most folks, once they realize what's out there, they tend to gravitate more towards cash flow than away from it. But really, find that balance, find where that is. And from that, you can establish some clear investment criteria and know the things that you want to look for, and start figuring out the different ways to go and deploy the capital that you have to meet those goals and provide the returns that you need. And obviously, I don't want to. I would be remiss if I didn't mention, we're obviously not giving financial advice, but this is something we ourselves have worked through, right? We're happy to have a conversation with anybody. You know, we've got links to schedule a call. We'd love if this is something that sparked an idea, or you just want to dive more into a story that we've talked about, or we can dive into our portfolios, things like that. We're obviously happy to do that for anyone. So there's again links in the show notes, but don't be afraid to reach out. We're happy to help, again, especially if you're new to this space, just learning it, or you're experienced, you've had some new idea. We'd absolutely love to chat about that.
Well, thank you, Dustin, and thanks everyone for listening. And remember, where freedom leads and real wealth follows. Join us next week when we dive into goal setting.
All right. Thanks, Adam.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.